Good morning, everyone, and welcome to our autumn tax update. I'm Aaron Hemmington, tax partner in Northampton office of Horsons, and today I'm joined by my colleagues Stephen Charles, Gareth Davies, and Ben Aris. Today we're going to look at various topical tax issues to include some of the changes announced in the recent budget. We will be holding a Q&A at the end, so if anyone has any questions, please submit them using the Q&A functionality within Zoom. We'll also be recording the webinar as well today, so if you need to leave early or you just want to go through it again, it will be available on our website in due course. Slide, please. Okay, so for those of you that are new to Horsons, this year we're celebrating our 170th year in business. The firm was initially founded in Sheffield in 1854. We've got 3 offices: Sheffield, Doncaster, and Northampton. We're an independent partnership with 12 partners and 100 staff. We're also a member of HLB International, which is a very large international network of accountants and business advisors. I believe we're now in the top 10 sort of table of the international networks. So a really good size and reach across the globe. Next slide, please. We offer a comprehensive suite of services, including audit, accounts, tax compliance and advice, payroll, corporate finance and wealth management. Okay, so today, different areas we're going to focus on include corporate and business tax, and Gareth Davies is going to present on that. We'll then move on to capital taxes, VAT and SDLT, which will be presented by Ben. I'll be looking at inheritance tax and non-domiciled individuals. And then Stephen will round things off with a look at employment and personal taxes. So without further ado, it's my pleasure to pass you over to Gareth Davies.
Thank you very much, Aaron. Good morning, everybody. Thank you for joining us. My name is Gareth, and I've been with Horsons for 12 years. I started off with small company accounts for a few years, then did audit for a few years, and now for the last 5.5 years, I've been doing tax. So I do a mixture of tax for corporate clients, non-corporate business clients, and for individual clients. Next slide, please. Starting off with corporation tax. So the main thing to say here is that there's not much that has changed. All of these rates that were introduced in 2023 remain in place for the foreseeable future. So if you're a company with profits, annual taxable profits of £50,000 or less, your rate is 19% corporation tax. If you've got profits of over 250,000, your rate is the main rate of corporation tax, 25%. And if your profits fall between 50 and 250k, then you're into the marginal rate. And your marginal rate ranges between 19 and 25%, depending on where you are in that range between 50 and 250. Next slide, please. Capital allowances, again, not much change. So all of these here are in for the foreseeable future. There's one further down that runs out in just over a year's time, 18 months. But anyway, full expensing. So full expensing was introduced in 2023, 100% full expensing on qualifying expenditure, mostly plant machinery, but excluding cars, as long as those assets are new and unused. The government are planning to explore extending full expensing to assets that companies have bought for leasing out. But we haven't received an update on that, so more to follow. The annual investment allowance, that will remain at £1 million until further notice. So good news on that, because that's been a bit unstable over the last decade or so. It's moved up and down, and now it's stable. The current 100% first-year allowance for specific assets, that includes zero-emission cars and electric vehicle charging points. So that is also in for the next 18 months or so. Lastly, HMRC is planning to clarify its guidance on what qualifies for capital allowances. This is good news for us because if anyone's seen the capital allowances lists, there's lots of things on there, but there's also areas for subjectivity and interpretation. And hopefully this clarifying guidance will clarify things. Next slide, please. R&D. R&D is changing in 2024. Those of you aware of R&D will know that there was 2 schemes up until now. There was the SME scheme for small and medium-sized enterprises, and there was the RDEC scheme for large companies. or companies receiving subsidies for doing their R&D. So from the 1st of April 2024 onwards, there will become one scheme which will hopefully make things simpler. And that will be introduced for accounting periods that start on 1st of April 2024 or afterwards. So the previous rules will apply if you've got a period that straddles that. The merged scheme offers an expenditure credit of 20%. That is the same as the current RDEC rate. And the credit taxable above the line, so that means it increases your taxable profit or reduces your loss initially. Reduces your profit. Increases your profit. Apologies, and ends up producing a effective tax saving of 15% if you've got taxable profits above 50k. If you have profits below 50k or you're loss making, your effective tax saving is slightly higher at 16.2%. And good news for loss-making SMEs, they'll still be able to claim or exchange their losses for the repayable tax credit. That's now 10%, unless you're R&D intensive. Very briefly, R&D intensive is if you have R&D expenditure that is more than 30% of your total expenditure on all things or most things. That R&D intensity assessment was introduced from April 23, and it was initially a 40% mark, but the government looked at this again and they considered that bar was too high, so they lowered it to 30%. Next slide, please. R&D compliance. So this was a lot of these measures were introduced in April 2023, but it's worth going through them again because the landscape has changed significantly in the last year or two with relation to the enforcement of R&D compliance from HMRC. So HMRC has increased its compliance resource to tackle perceived abuse of the R&D schemes. Companies now need to submit more detailed and robust R&D claims than before to justify why they're eligible for the R&D tax reliefs. HMRC has also introduced a couple of additional hoops to jump through. New reporting requirements include notifying HMRC of R&D activities in advance of the period end. This is only in cases where you've either never submitted an R&D claim before or you haven't submitted one in the last 3 accounting periods. And then once your year end's done and you're wanting to report your R&D activities with your numbers, the submission of an additional information form is now required in addition to the CT return. And that's a separate disclosure that's done through a new portal and answers HMRC's prescribed questions. It's now more important than ever to keep accurate records of each R&D project. They need to be separated. They may not have been before, they need to be now. And this all adds to the additional work and the additional risk associated with R&D these days, because there's thousands of new inquiries that HMRC has launched, meaning that there is a higher risk of some of our clients' R&D claims, some of your R&D claims being challenged by the revenue. They'll want to know more about why you're entitled to the relief. It's very time consuming and it's very, very cumbersome. So it needs to be highlighted that you need to make sure that you're doing R&D, you meet the criteria more so than ever before. Next slide, please. Moving away from CT now, mostly. Furnished holiday lettings. So the FHL tax regime, these are mainly Airbnbs and equivalents. That scheme will be abolished from April 2025. This was initially suggested by the previous government, and Labour has now confirmed this will happen. FHL properties will be subject to the same rules as normal residential property letting businesses. This applies to individuals, corporates and trusts who operate and sell furnished holiday lets. So furnished holiday lets used to have a number of tax advantages, and basically they're all being phased out. So there's no longer relevant earnings for pension purposes, which used to be the case for FHLs. There's no relief for residential property finance costs as a deduction from the FHL business profits, but instead you do get the tax reducer on your income tax return, but that's less generous. No capital allowances anymore for capital expenditure incurred at the FHL. Capital gains tax reliefs are no longer available. So there's things like rollover relief, holdover relief, and business asset disposal relief. And there are some transitional provisions that will apply navigating through April 2025 and beyond. Next slide, please. treatment of double cab pickup vehicles. So as the picture suggests, these are your vehicles that have 2 seats in the front, 2 or 3 seats in the back, and then they have the pickup portion, or they have a roof and a van-like portion behind. So it's those specific vehicles. There's obviously numerous options available. These vehicles have caused a bit of controversy in recent years because there's been a bit of toing and froing from the previous government and the current government. Well, actually, the previous government to and froed. Now Labour have hopefully clarifying the position. But these have been treated as vans historically, and vans traditionally, because they're more closely associated with business use, attract more tax relief and less tax exposure, whereas cars are more closely associated with private use, and then you get higher tax exposure, fewer tax reliefs, broadly speaking. So the government will treat double cab pickups with a payload of 1 tonne or more as cars from the 1st of April 2025 for corporation tax purposes, and from 6th of April 2025 for income tax purposes. The existing capital allowances treatment and benefit in kind treatment will apply to those who purchase these vehicles before April 2025. So there's a couple of planning points here. First of all, if you're going to plan on buying a new one of these, buy it within the next 6 months. If you're looking at buying one beyond April 2025, a potential consideration is considering a low emission one or lower emission one. Apparently there is such a thing. It sounds like the Ford Ranger next year is bringing out a plug-in hybrid version. I'm sure other options are available. But that's another option which will lower the tax exposure because there should be slightly more capital allowances available and a lower car benefit for income tax and P11D purposes. The other option is if you don't need one of these pickup trucks, now the loophole is closing for these tax advantages, consider other cars preferably with low emissions, because again, there's some tax advantages for going for lower emissions. Next slide, please. Company vans, just a quick one here. A reminder, the current company van benefit in kind is 3,960 for the 24-25 tax year. The van fuel benefit, 757 for 24-25. And the change here is that from the 6th of April 2025, so the 25-26 tax year, the van benefit and the van fuel benefit will start to uprate based on the consumer price index. Next slide, please. Self-employed and NICs. So a reminder, the rates of the class 4 payable by self-employed people making profits is 6%. That's payable on annual taxable profits between 12,570 and 5270. And then the rate drops to 2% on annual taxable profits above 2%. These will remain the same from 6th of April 2025. And then on class 2, position is changing from 6th of April 2024. So the self-employed will no longer be required, keyword required, to pay class 2 NIC anymore. However, those that are generating small profits beneath 6,725 annual taxable profit, they can voluntarily contribute via class 2 in order to build up their entitlement to the state pension and other contributory benefits. And if you want to contribute voluntarily, the weekly rate is £3.45 for 24-25. Next slide, please. Loans to participators of close companies. This is a niche and narrow point, but one worth quickly mentioning. If you're a participator in a close company and you have a loan from your company, there's been a bit of anti-avoidance legislation introduced here to close another loophole whereby you could potentially advance a further loan from one of your other companies that you control, either a group company or an associated company, and then effectively use that second loan to pay off the first loan. But in reality, you haven't actually repaid any of the loan. And that practice was a scheme that was able to avoid the Section 455 tax that is payable by the company that has advanced the loan. It's a bit of a weird tax because it's eventually repayable after the loan has been repaid. But anyway, there's a bit of anti-avoidance, quite niche, quite contrived behaviour that this is tackling. It may apply. Next slide, please. Multinational, a couple of points here. So you may have heard The government will introduce the under-tax profits rule, being the final part of the OECD global minimum tax, agreed by over 100 countries and jurisdictions. This will take effect from accounting periods beginning on or after 31st December 2024. And there will also be additional amendments to some more recent legislation on the multinational top-up tax and the domestic top-up tax legislation. The main objective of this legislation is to target very large companies that operate globally and attempt to shift their profits into low tax jurisdictions. The objective here is to create a framework whereby those sorts of companies that are doing that will suffer a minimum global tax of 15%, to hopefully close some of the loopholes for moving your profits to low tax jurisdictions. This is very detailed, it's very complicated, so there's a lot to it. So I would say that it's probably only going to affect you if you're part of a very large group and that group is operating in low tax jurisdictions. Next slide, please. Final slide. Compliance, a few compliance points here. HMRC has announced compliance initiatives, including investing in additional HMRC compliance staff, apparently 5,000 are on the way, and debt management staff, 1,800 on the way. We'll see if they can achieve that. You can't just find 7,000 people out of nowhere, so we'll see how they get on. They've made these pledges before, but this is all with the view to tackling compliance, improving compliance across the country, and also chasing debt more effectively. They're also going to be putting in more money into modernising the HMRC debt management IT system, so hopefully it's chasing debt more effectively, making fewer mistakes, chasing the right people at the right time. And they're also planning to increase, or they're going to increase, the late payment interest rate on most taxes by 1.5% from the 6th of April 2025. So it's currently 7.25%. It's going up to 8.75%. Ouch. That's all from me. Thanks very much for listening, and it's on to Ben.
Thanks, Gareth. My name's Ben. I'm a tax consultant here in the Sheffield office, dealing with both business and corporate tax. And I'm going to start today by talking about capital taxes. Now, the old saying goes to pluck the goose so as to obtain the largest possible amount of feathers with the smallest amount of hissing. Luckily, you guys are on mute today, so I won't be able to hear any of the hissing going on. So I'll go through some of the changes that were announced in the last couple of months in the budget and other changes as well. Next slide, please. So capital gains tax rate rises. This wasn't unexpected, but it wasn't as dramatic as some people thought it might be. So for disposals made on or after the 30th of October 2024, the main rates of CGT for assets other than residential property and carried interest, there's going to be a CGT raise from 10% and 20% to 18% and 24%. Now, this is going to bring in line with residential property rates at this moment in time. And so you'll no longer have to differentiate between assets themselves. Residential property gains are going to stay the same at 18 and 24%. And the capital gains tax rates for trustees and personal representatives is also going to increase from 20% to 24%. Next slide, please. The annual exempt amount is expected to stay the same, so £3,000 to set against your chargeable gains per year. And so despite widespread speculation, there was no actual removal of the CGT uplift on death, despite the OTS recommending its removal. Now, this effectively resets the clock on the gains made for CGT, and the person actually receiving the asset will receive a market value at the date of death. And this sort of ensures that there's no sort of dual hit for IHT and CGT, so it should always be considered as part of tax planning. Next slide, please. BADR, quite a common relief. And again, many people thought it was going to be removed, but it looks as though it's here to stay for a while. So it's a CGT relief available to business owners with chargeable gains on qualifying business assets. Now, the CGT rate is 10% up to a lifetime limit of £1 million. and this £1 billion limit has stayed the same. The government, the rationale behind making these changes is to help businesses adjust to the changes, is what they've said. And it is going to be less favourable going forward. So, for example, from the 6th of April 2025, the rate's going to increase from 10% to 14%. And then again, from the 6th of April 2026, it's going to increase to 18%. So then it will start to match the main lower rate for other assets as well. So it's going to be important here to look at when the date of disposal is going to be, because then you could be going from, for example, 10% to actually 18%. What the government have also introduced is something called anti-forestalling measures to prevent taxpayers from avoiding these higher rate of BADR by making election to trigger historic share reorganisations. So if you've had such as share-for-share exchange between the 6th of April 2024 up until 29th of October 2024, just before the budget, you should seek advice on this position, because potentially there could be scope to claim a lower percentage of BADR. But that's going to be important so it's best to get advice to see if the 10% is still available. Next slide, please. Investors relief, similar relief to BADR. So it's on the disposal of qualifying shares in unlisted companies, but there are separate conditions to BADR. Now, the lifetime limit announced in the budget recently was that it was going to reduce from £10 million to £1 million for disposals made on or after the 30th of October 2024. And this is actually going to match the BADR limits that are currently in place. So the limit does take into account current and prior qualifying gains as well. And as with BADR, the rates are going to increase to 14% from the 6th of April 2025, and then again to 18% from the 6th of April 2026. So in summary, the eventual outcome of all of this is that there's going to be a simpler regime with just two tax rates, and you won't need to differentiate between assets. Previously, you would see how you could allocate your annual exemption amount, but this nowadays is going to be very, it's going to make it simpler, but these reliefs are going to be less favourable. Next slide, please. Carried interest. It's not something that I've had personal experience on, but there's been a lot of consultation recently on carried interest reform, and there's going to be further consultations as well about further conditions to attach to this. Now, as individuals who provide investment management services to investment management funds and they receive this carried interest, it's currently taxed under the CGT regime, but the government are wanting to introduce new changes. So as an interim step, they're going to increase the CGT rate to 32% for interest received on or after the 6th of April 2025. Then what's going to happen as a further step, they're going in April 2026, all the carried interest is actually going to be taxed within the income tax framework. So it's going to be subject to income tax and class 4 national insurance contributions. Now, once you get that carried interest, it looks as though there's going to be a multiplier of 72.5%. It's going to apply to the qualifying interest brought within the charge, and that is to bring down the effective rate of tax. Next slide, please. LLPs, this is quite a niche point, but I'll go through it quickly. And it seems to come from a recent case where some people were seeking to avoid having to pay a CGT charge. Now, traditionally, there's no chargeable gain when a member contributes an asset to an LLP, generally, but the appointment of liquidator does changes matters. So when the member eventually gets the asset back, traditionally, there was no gain made on that asset going back to the member. Now, what these new rules are going to do, essentially, is that the member is going to be deemed to sold and then reacquired it at market value at the time of the original disposal. And so essentially, there's going to be CGT charge triggered on the return to the assets, the members on the liquidation of the LLP. And so this is going to be effective for liquidations on or after the 30th of October 2024. It's quite a niche point, but please feel free to get in contact afterwards if you want to discuss this further. Next slide, please. SDLT changes. So as you've got to see on the slides there's an increase from 3% to 5% for transactions with an effective date on or after the 30th of October 2024. As this will be people such as purchasing second homes or purchases of residential properties by companies and other non-natural persons. There's also going to be an increase for companies and other non-natural persons when purchasing residential properties worth more than 500,000. It's been around for a while now, but it's going to increase from 15% to 17% from the same date. Now, these changes will not apply where the contract was entered into before the 31st of October 24, but there are some important exceptions to this rule. I think this is one point that hasn't really been picked on, but the temporary concession thresholds will not be continued when they expire on the 31st of March 2025. In the previous government, there's been a temporary concession in place to increase the nil rate thresholds. So this is given a relatively small window to obtain the relief on these higher nil rate thresholds. So it's something to bear in mind going forward. Next slide, please. EOTs is something that we deal with regularly here at Horsons, and so I'll mainly focus on the changes to EOTs. Now, for those that aren't aware of what an EOT is, Employee Ownership Trust, is a type of trust set up to allow the employees to obtain a controlling interest in the company. Now, where the qualifying conditions are met, for the person that's actually selling it to the EOT, will be treated as a no gain, no loss, which is, very beneficial. It's very generous, and it sort of helps out those as well who have limited availability to BADR. Now, there's a tax-free bonus as well that can be available to employees. Unfortunately, this wasn't increased, which I thought some people would. Well, yeah, people were expecting it to be raised because of how it's meant to be leaning towards employee ownership, but there was no changes announced. But there were some changes announced in the autumn statement, effective from the 30th of October 2024. These weren't, unexpected. There was a consultation that took place earlier in the year, and HMRC have been sort of targeting the area because they see that potentially they consider some potential abuse that could take place within these EOT if further measures weren't introduced. So there's some measures that are contained below. So, for example, they want to restrict former owners or people connected to them retaining control of the EOT itself. This is important to obviously make sure that the EOT is actually in control and the former owners don't have a say in how it's run going forward. There's also an extension of the period in which HMRC can withdraw that no gain, no loss treatment that I discussed earlier. If the conditions of the EOT are not met to the end of the 4th year following the disposal. So obviously this is important that these conditions are met, because then there's a gain that could come back into play here, and then the relief is just ignored. And there's going to be additional information required when claiming the CGT relief, such as the number of employees of the business. And there's going to be a requirement that trustees of the EOT are UK resident at the sale to the company as well. And lastly, that's not on the slides as well. So the consideration paid for shares must not exceed market value. So generally, when we go through these transactions anyway, we carry out a robust valuation. But it is important that these valuations do take place so as not fall foul of this new measure that's been introduced. Next slide, please. VAT, not many changes were announced. The VAT threshold is going to remain at 90,000 and the deregistration threshold is 88,000. There's been a lot of stuff in the news recently. You probably read about private school fees. It's something that's quite a hotly debated topic at this moment in time. But from the 1st of January, all educational services and vocational training provided by private schools or connected person in the UK will be subject to VAT at the standard rate. Now, there are further conditions about prepayments. So if there's prepayments of fees or board and services on or after the 29th of July 2024 that relate to terms actually starting on from the 1st of January 2025, what's going to happen here is these are still going to be included within the rules and will be subject to VAT. So making prepayments in advance for terms in the future isn't really, doesn't seem as though it's going to cut it really. Now, but if the prepayments were made before the 29th of July, HMRC are going to be looking at when the tax point was created. So that's going to be important going forward. And, you know, if there are any sort of private schools listening, they should probably get advice of these prepayments for those, you know, that are paying the school fees as well. And effectively all of this as well, the private schools need to be aware of the VAT registrations and compliance that are coming into place. You know, I've seen out there recently there's been some struggles about getting some registrations sorted for the private schools. So yeah, so best to sort of get advice in that position. Next slide, please. But yeah, that's me. Thank you for taking the time to listen today.
Okay, thanks, Ben. So I'm going to start off by looking at some of the changes to inheritance tax, and then I'll move on to look at some of the changes regarding non-domiciled individuals. So first up, inheritance tax. Next slide. Okay, so as I'm sure many of you are aware, the nil rate band provides a 0% rate of inheritance tax on the first £325,000 of an individual's estate. It's been fixed at 325,000 since around 2009, and unfortunately it's going to remain fixed at that amount until April 2030. And this is another example of fiscal drag where tax allowances and bands don't move in line with inflation, resulting in increased tax in real terms. It's quite interesting to look at how our system compares to other countries. Obviously, there's quite a lot of other countries in the world that operate a system of inheritance tax or estate duty, and they all have their own systems where they have exempt amounts or exempt bands. So just looking at how our nil rate band compares to some of the other countries in the world, there really is, you know, a wide range of amounts. So at one end of the spectrum, you've got countries like Belgium that have got a very low threshold of around €12,500. And at the other end of the spectrum, you've got countries like the USA that have got an equivalent nil rate band of $13 million. So there's a real wide range there. And there are some countries that have actually abolished IHT altogether. I can't see that happening in the UK in the foreseeable future, though. So in the UK, we've also got the residence nil rate band. And this is an additional nil rate band of 175,000. Available to each individual, which they can offset against the value of their main residence, where that is left to direct descendants. And when talking about direct descendants, we're looking at sort of children and grandchildren, so lineal descendants, but not sort of nephews and nieces and things like that. That's also going to be fixed until 2030, so a bit more fiscal drag on that as well. And the residence nil rate band is also it's reduced by £1 for every £2. The total value of someone's estate before reliefs exceeds a threshold of £2 million. That threshold is also going to remain at 2 million. It's also worth remembering that the nil rate band and the residence nil rate band is transferable between spouses. Therefore, you know, if matters are arranged correctly, it's possible for a married couple to pass up to £1 million worth of assets to the next of kin without IHT. But you do have to make sure that, you know, your wills are correctly structured in order to take advantage of that. Remembering that the residence nil rate band is only available on death. So yeah, you might want to review your wills if that's something you're concerned about. And yeah, also the IHT rate 40%. That's going to remain in place. That's compared to an OECD average of 15%. So we're quite high there. I think we're in the sort of top 4 or 5 countries in terms of the rate of IHT that we levy in the UK. Next slide, please. Okay, so moving on to agricultural property relief and business property relief. It's obviously been very controversial, and the farmers have been marching on Westminster this week to raise their concerns. So, yeah, for many years, APR and BPR have allowed 100%, of the value of agricultural property and business property to be passed free of IHT to the next generation where certain conditions are met. That's enabled farms and businesses to be carried on by the next generation without the business or its assets having to be sold to fund IHT. So very broadly, 100% APR is available on land and buildings occupied by the owner for the purposes of agriculture throughout the 2 years prior to transfer or death, or it's been owned by them for the 7 years prior to that and occupied by someone else for the purposes of agriculture throughout that period. 100% BPR is available on an interest in the trading business or shares in a trading company or group which have been owned for the 2 years prior to transfer or death. However, the big change is from April 2026, the full 100% relief from inheritance tax will be restricted to the first £1 million of combined agricultural and business property. And above that £1 million allowance or threshold, relief is going to reduce to 50%. And that will result in an effective rate of IHT of 20% on any value above 1 million. Again, important to note that £1 million is combined. So if you had a farming business worth £500,000 and an unrelated trading company that was worth £1 million, then the total of APR and BPR that you could receive would be at 100% would be capped at £1 million. And then in that example, on the balance of 500,000, you would get 50% relief with effective tax at 20% on that 500,000. Okay, next slide. So, yeah, a further change from April 2026 will impact business property relief on shares, on AIM listed shares. So, yeah, for many years, investments in shares listed on the alternative investment markets have qualified for business property relief after they've been held for 2 years. And that's been a really popular IHT mitigation route for people, with lots of cash, as it allows you to get the BPR relief without the hassle and risk of setting up a business. There was a lot of concern that business property relief was going to be completely abolished on AIM shares. And I think a lot of concerns were raised by various industry bodies regarding that. So in the end, the government have decided just to reduce the rate of BPR down to 50% from 6th of April 2026. It's also important to note that rate of relief will not be affected by the £1 million allowance, so all shares will only attract 50% relief regardless of their value. Next slide, please. So IHT on pensions. So the current position is that pensions and death benefits payable from pensions are not subject to IHT. And then you're in a position where death benefits that are paid if an individual dies before the age of 75 are passed entirely tax-free to the next generation or next of kin. And then death benefits payable if an individual dies over the age of 75 are then taxed at the recipient's marginal rate of income tax. The proposed change is that the government is going to bring unused pension funds and death benefits payable from a pension into a person's estate for inheritance tax purposes from April 2027. So our current understanding of how that's going to work is the value of the pension will be included in the estate. We then need to, an IHT will be levied, potentially depending on availability of the nil rate fund, etc. You'll then need to consider if there's also some income tax. The current understanding is if the individual dies under the age of 75, the net fund after inheritance tax could still be passed free of income tax to the next generation. But if the individual dies over the age of 75, the fund net of inheritance tax would then be subject to income tax at the individual's marginal rate. And that could actually result in potential effective tax rates on the fund of up to 67%, particularly if the beneficiaries or the next of kin are additional rate taxpayers. So we're still waiting for a lot more detail on how that's going to really work, and the government's opened a consultation on that. So very much a case of watch this space on that one. Slide, please. Okay. Moving on to non-domiciled individuals. So for a number of years, non-domiciled individuals that are resident in the UK have been able to use something called the remittance basis. And basically that's allowed them only to pay tax in the UK on foreign income and gains, to the extent that that foreign income and gains is remitted to the UK. And it's actually a concept that can be traced back as far as 1914. But obviously, in recent years, it's become quite sort of controversial, particularly sort of, the well-known example is Rishi Sunak's wife. She was a remittance basis user. That caused a lot of controversy. And obviously, it's drawn a lot of attention to the remittance basis. Amongst obviously examples of other individuals using it, and obviously it's been deemed to be not fair. When compared to someone that's resident and domiciled in the UK, has to pay tax on all of their worldwide income and gains. So they're looking to sort of obviously level the playing field there. So yeah, it's being abolished from April 2025. And we've got a new regime that's coming in. So if you've got a non-domiciled person that comes to the UK, they'll have 100% relief on foreign income and gains the first 4 years of tax residence. And then after that initial 4-year period, they'll be taxed on their worldwide income and gains in the UK. For CGT purposes, they are going to be allowed to rebase foreign assets held on 5th of April 2017 to their value at that date. That might enable them to limit capital gains exposure in the UK. And also in terms of some of the sort of transitional provisions, foreign income and gains that arose on or before 5th of April 25 will continue to be taxed when remitted to the UK, as they are under the current rules. There's a temporary repatriation facility available where reduced rates will apply to those remittances. So the temporary repatriation facility is going to be available for a limited period of 3 tax years. And the rate will be 12% for the first 2 tax years and 15% in the final tax year of operation. So I think the government are hoping that's going to encourage a lot of non-doms to bring loads of money into the UK, and then that's going to help fuel the economy and also boost some tax receipts as well. Okay, next slide, please. So in terms of non-domiciled individuals and inheritance tax, historically, non-doms have only been subject to UK IHT on UK citus assets and not worldwide assets, unless they've been resident in the UK for 15 out of the last 20 years, in which case they've been sort of deemed domiciled and exposed to UK IHT on worldwide assets. So that system's going to be replaced by a system that's wholly kind of residence-based, and individuals are going to be, non-domiciled individuals are going to be exposed to IHT on their worldwide assets if they've been resident in the UK for 10 or more of the previous 20 tax years, and that's referred to as being long-term resident. And if someone then leaves the UK, the legislation is to deem them to remain in scope for UK IHT for between 3 and 10 years after leaving the UK. The exact length depends on their initial period of residence. So again, we'll look forward to seeing more detail on that and advising clients affected accordingly in due course. That wraps up my section, so I'm going to pass over to Stephen Charles. Thank you.
Thanks, Aaron, for that. I'm conscious we're sort of running out of time, but fortunately my section doesn't have so many changes, so we can rattle through that quite quickly, I think. So yeah, next slide, please. So yeah, national insurance, obviously quite a few changes around that. I mean, national insurance is a bit of a strange one. It does tend to get changed quite frequently. It's not so long ago that Boris Johnson's government put national insurance up by 1.25 percentage points. But that didn't seem to create quite as much of a storm as this change. I think This change not only is a 1.2% increase in employers' national insurance, but that's been combined with this reduction in the threshold at which employers start paying national insurance. So that's dropped from £9,100 to £5,000. So that costs about £600 per employee. So I think the two changes, the increase in the main rate from 13.8 to 15%, plus this drop in the threshold, so it's a double whammy, and it's caused quite a furore really, and a lot of kickback against the government there. For the very small businesses, this is sort of offset this increase by the increase in employment allowance from 5,000 to 10,500. So if you're a micro business, handful of employees, you're probably completely insulated from the increase. You might be slightly better off, but for most businesses, there's certainly going to be a cost, and the more employees you have, the bigger the cost. Another little tweak on the employment allowance is that the cap, so £100,000 was only applying for the smaller businesses. That's been removed, so it applies to all businesses now. But for very big businesses, it's a drop in the ocean. So a little bit of a strange change, I think, that last one. But there we go. Okay, next slide, please. So again, we've got some inflationary changes there. It's a small profit threshold, and the self-employed class 2 and the voluntary class 3. Thank you. Next slide. Another thing just on for veterans as an employer, NIC relief for veterans, that's been extended for another year too. Next slide. I think another thing which meant that the employer national insurance change was so widely condemned was that aligned with an increase in the national minimum wage of 6.7%. So obviously that's not a tax, but it's another cost to businesses. So not only are those on the national minimum wage having to be paid an increase 6.7% next April, that obviously has a spiral impact on the rest of the workforce. So that's a big cost as well, unfortunately, to those businesses with lots of employees. There's also plans to combine the rates. So at the moment, younger people don't have to be paid the full rate. There's lower rates for younger people. There's plans to remove that and to pay everyone the same. We'll have the same national living wage for everyone. But yeah, we'll have to wait to see the details of that. Thank you. Next slide. So a few changes on company cars as always. Electric cars are still very generously taxed from a benefit in kind point of view, but that has gone from 2% to 3%, but still, very good rate. For other cars, it's gone up by a percentage point, with the maximum being 37%. We're seeing very few people these days with company cars unless they are electric. Otherwise, it's quite an expensive benefit. And car fuel is again, well, that's a particularly expensive benefit, so very few people take that these days. If you have an electric car, and the company pays for the electricity, that's not a benefit for fuel, because electricity isn't considered a fuel. Next slide, please. So yeah, part of the sort of digital revolution, all benefits in kind plan is to get them all payrolled from April 2026, which will be the end of P11Ds, which have been a staple of the tax landscape for many years now. But technology hopefully will supersede them, but remains to be seen how smoothly that change will go. Next slide, please. The revenue is still concerned about abuse through the umbrella market, where people are being paid through umbrella companies, and there's abuse going on there. So there's going to be more restrictions around that. Thank you. Next slide. And again, also with car ownership schemes, lots of people promoting car ownership schemes. Some I think are quite legitimate, others probably more on borderline. So government again looking at that. Thank you. Next slide. So Aaron mentioned fiscal drag. I think it was Gordon Brown who came up with that. So you don't increase tax rates, you just don't increase allowances. Has a similar impact, but it just doesn't have quite such a, it doesn't sound so draconian. So yeah, basic rate bands are staying the same, 37,700 added to the personal allowance means that people start paying high rate tax at 50,270. That's going to be frozen to April 2028, which they then say will start going up after that. And the NIC thresholds are going to remain aligned. Thank you. Next slide. So yeah, as I say, the plan is then to start increasing it by inflation, but who knows, that's quite a long way away. Yeah, and as is currently, people start paying 45% tax once they get to 125,140, which is the point when the personal allowance has been completely lost. Thank you. Personal allowance again, likewise, is being fixed until April 2028. And as is currently the case, that gets removed once income goes over 100,000. So in that tax band between 100,000 to 125,000, there's an effective rate of 60% income tax, so very penal rate, quite unfair really. But we've had that problem for a while. Although when it came in, 100,000 was worth quite a lot more than 100,000 is worth today. So again, fiscal drag at play. Thank you. Next slide. Savings income. The tax allowances have stayed the same this year. Thank you. Next slide. Tax on dividends. Again, allowances are staying the same. Dividends at a slightly lower rate of income tax to employed income, and that's because the company paying the dividend has already paid corporation tax on those profits before they're distributed. But still quite a good rate for basic rate taxpayers in particular, under 10%. So that's quite attractive. Yeah, but the differential between bonuses and dividends is now much reduced than what it used to be. Thank you. Next slide. Pension limits. On this aspect of pensions, there wasn't really any changes, so that's positive, I think. The annual allowance is still at £60,000. That does get reduced if income is high. So if your adjusted income is over 260, then it does get scaled back down to a minimum of £10,000. But I think the increase from £60,000 from £40,000, which happened a little while ago, has been beneficial and has meant that quite a lot fewer people are caught up by tax charges on their contributions to their pension. Particularly popular, good for doctors. A lot of those were being caught, but it's fewer now. So yeah, it's beneficial that's stayed as it is. It's important to remember that the annual allowance that does take into account employee and employer contributions. Thank you. Next slide. Individual savings allowances, no real change there. They've continued as before. So those thresholds are still there. Thank you. Next slide. Child benefits. So back in the last government did raise the threshold at which there's a clawback of child benefit, which is definitely the right thing to do. So that's gone up from 50,000 to 60,000. Probably should have gone up more, but anyway, it's good it has gone up. And now that gets withdrawn at 1% for every £200. Previously, it was for every £100. So it's clawed back if your income is between £60,000 and £80,000. Once you get to £80,000, it's completely withdrawn, and that's based on the higher earners' income. Conservatives did suggest they were going to look at it on a couple basis. I mean, that seems to be very difficult to do, and that proposal has been withdrawn, not surprisingly, I think. But yeah, a welcome change, which is going to carry on. Thank you, Amy. Making tax digital, that has been postponed, but we are coming up towards that date where it's going to take effect, April 2026. So yeah, people with income, self-employed income or rental income will need to start thinking about that. the plan is that eventually that's going to come in for those with 20,000 of income. It's a bit of a weird one. The technology seems to have gone beyond this. A lot of countries, you do need to report all income. Invoices have to be reported as they're raised. Making tax digital from the UK perspective just seems a little bit antiquated, really, compared to other jurisdictions, but they're pressing ahead with that. Next slide, please. Yeah, so that's it, really. Just coming up to the hour there. But thank you if you stay to the end. Thank you very much for that. We did have a few questions, which I think we'll try and have a quick look at in the last couple of minutes.
How will businesses be valued when calculating IHT when the BPR is reduced to 50%? Yeah, I think the point is valuations are going to become crucial with this, and getting the valuations right, applying the right sort of minority discounts that may be available there. I know the person that's asked this question said it doesn't seem right to include a future profits multiplier within the valuation. I mean, generally, if you're looking at a trading business, you will be looking at a multiple of profit, but there may be other methods that could be employed. It just really depends on the nature of the company and kind of how it's performing, really. So it's difficult to give a comprehensive answer to that question at this moment in time. But yeah, I think just underlines the point that valuations are going to be absolutely crucial going forwards, and even more important, obviously, than before.
We've got a question about pensions. I mean, the changes aren't due to come until April 2027, so I think there's a long way to go before we have the final details of how that's going to look. So I think it's one of those where we're going to have to watch this space, see what comes up in the next few months, but hopefully there'll be some clarity on that.
Another one on IHT, recommendation strategies for dealing with changes to APR for farming businesses with assets greater than 1 million threshold. Yeah, one thing that I meant to mention in my section was that each individuals have this 100% £1 million threshold. So if you've got a husband and wife, they'll each have a £1 million threshold each. And also trusts as well. Trusts will have their own 1 million threshold for APR and BPR. It needs to be a case of looking at planning to make sure everyone's using their £1 million threshold, looking at gifting, looking at trusts. Obviously, each case needs to be looked at based on the factors that are in play there. It's sort of difficult to give a one size fits all answer on that. But obviously, if you want to have a chat with us about that, then be happy to sort of discuss it further. I think a lot of the other FAQs, other questions we've had in have sort of been covered in the content, to be honest.
Yeah.
Yeah, so as I said, if anyone's got any further questions, they want to discuss things in more detail, please feel free to get in touch. Either one of us or the engagement partner that deals with your affairs. So, again, to reiterate, Steve, thanks for attending today. And thank you to Rob and Amy in marketing for helping us arrange this. So, all the best. Have a good day, everyone.
Thank you.
Thank you, everyone. Cheers.
Thank you very much.